Thank you all for waiting. We'll get started for the sake of time. Good morning, everyone. For those who don't know me, my name is Shannon Gerlach. I am a marketing communication specialist here at the Koffman Southern Tier Incubator. We are very excited to have everyone here this morning for the first of our monthly webinars that we'll be hosting going forward. I know a lot of you are involved with the Koffman or are one of our startups going through one of our programs or one of our companies that receive mentorship or have office space here. But for those that are not familiar with the Koffman, we are a startup incubator stationed here in Binghamton, New York. We are associated with Binghamton University, and we are dedicated to fostering innovation and entrepreneurship here in the Southern Tier and beyond. We provide supportive environments and mentorship, programming, office space, and so many more resources to our startups that we work with, access to funding, et cetera. Our mission is to accelerate the growth and high potential businesses that we work with and contribute to the economic development of our region and beyond, as we do work with startups that are not just here in the Southern Tier. We are able to do so through programs like this and through our additional programming. Again, if you're not familiar with us, feel free to head to our website, thekoffman.com, to check us out and learn more information. But for the reason that we're all here today, I'd like to introduce our speaker, Olga Laouchez. Olga is a seasoned venture investor and exited entrepreneur. She's got 19 years of experience working at the intersection of technology, impact, and sustainability. She currently advises family office clients on venture and social impact investments, offering expertise in venture strategy, deal flow curation, and due diligence services. Olga has diligenced over $4 billion in investments and advised over 80 startups during her career, and is currently the general partner of the Portfolio Green and Sustainability Fund, focusing on climate tech solutions in that. We are incredibly fortunate to have Olga with us here today. Olga's going to take us through a fantastic presentation on preparing for fundraising, getting yourself ready for that next stop, preparing your deck, and all that goes into that. So, Olga, I'd like to say thank you and welcome, and we're very excited to have you here with us.
Awesome. Thanks so much, Shannon. As we begin, I'd love to get to know some of the audience members. So if you can drop into the chat your name, where you're located, and sort of what you're working on, that would be super helpful. In the meantime, I'm going to pull up this presentation and we can get started. I hope that everyone can see the slides. Let's see. Bandana is joining from Binghamton, New York. Good to see you, Bandana. Thank you for chiming in. Would love to hear from more folks in the audience, just where you're based, what you're working on. If you'd like to, you can also share whether you have any experience with fundraising, just so that I have a sense for the level of awareness of the topic within the audience. That would be super helpful as well. And the chat section is just located at the bottom of the Zoom screen. Very good. So excited to get started. As Shannon mentioned, my name is Olga Laouchez. I'm based here in New York City. I am a partner in Portfolio's Green and Sustainability Fund. It's a climate tech fund focused on supporting diverse founders, building climate tech solutions across different sectors, ranging from energy to the built environment, transportation, food and ag, and consumer. And we write $250,000 to $500,000 checks into companies from seed stage and up. So we don't look at pre-seed companies. We are looking for more kind of revenue generating, ideally, startups that have a bit of traction. Let's see, looking at the chat here. We have Anna from Binghamton. Welcome. Emily from Binghamton. Very cool. Catherine, fantastic. Thomas here in Brooklyn. Very good. Gautam in Burlington. Carrie. Jean and Mike, welcome. Joseph in Yonkers, fantastic. We have great coverage here. Valerie in Bethlehem, Pennsylvania, and Ling. Thank you everyone for sharing. Very good. So as Shannon mentioned, I have more than 20 years of experience at this point within the venture capital environment. I've been both on the investor and the operator side. So on the investor side, I've worked for a few different funds, including Insight Venture Partners. That's a large, over 100 billion in assets under management fund here in New York City. I've also helped start a few different startups, including a very, very deep tech quantum computing startup in the Bay Area, which is a Y Combinator Andreessen Horowitz backed company that went public on NASDAQ in 2022. So I've seen fundraising from different angles, and I've definitely been in the fundraising, in the founder seat. So I know how difficult it is to begin to think about how to get your ideas funded. So let's chat about like what is fundraising. So fundraising, very simply put, is the process of securing capital or plainly said, money from investors to fuel your startup's growth and operations. So in the chat, if you can just drop in whether you've raised funding before or if you're just starting, you can put 1 if you've raised before, even if it's just friends and family capital, and drop 2 into the chat if you're completely new to the process and you're just starting out. I'd love to get a sense for where folks are at within that. So let's see. We have 2, 1, 2, 2, 1. Very good. Michael is sharing that he's raised 20 million in his personal company. Very, very good. Very good. 2, 1. Let's see if anybody else wants to share. Would love to get a sense for people's experience with the topic. 1. Very good. Okay, so it looks like it's a bit of a mix of folks that are maybe familiar with fundraising. Some have done fundraising in the past, and then some are here just to learn. So again, fundraising is simply a way to finance the operations and the growth of the company that you're looking to build. So there are different sources of capital to be able to start and grow your business. A lot of people start with just bootstrapping. Bootstrapping is essentially using personal savings to fund the business. It's oftentimes the first source of funding for many entrepreneurs. And I know a lot of entrepreneurs that are so passionate about their idea, they're dipping into their college funds for their kids or their retirement funds and other pools of capital that they've accumulated throughout their life. But that's usually the first way to get started. Friends and family is another way to finance your company. So this is borrowing or receiving investment from personal contacts. This can be both informal and formal, but in either case, it should be properly documented to avoid any issues down the line. And oftentimes, these people could be maybe some folks that you've worked with in the past. Maybe it's a former boss that has seen how great and how passionate you are in your particular field. Sometimes it's high net worth individuals within your friends or family circles that are investors and that have had experience investing. Sometimes it could be advisors or people that have built similar companies in the past. Maybe they have sold them and have thereby been able to build quite a bit of capital, and now they're trying to support other entrepreneurs in the space. So that's the friends and family round. And again, that's one of the earlier stages of fundraising is you reach to your immediate network, people that know you really well, that trust you, that believe in your idea. They will be the kind of the immediate supporters of your company. From there, you can expand to angel investors. So angel investors are wealthy, high net worth individuals who invest their personal funds in early stage startups. Oftentimes, they also provide mentorship along with capital because they have usually been able to build their own businesses in order to generate the capital that they have. So they can add a lot of value and share their experience and their know-how as well as their capital. There are different angel networks that exist. So here in New York City, we have New York Angels. We have 37 Angels specifically for female founders. A lot of large universities have their own angel networks as well that you can tap into. For example, there's Princeton Angels, there's Harvard Angels, Alumni Ventures is a big organization that kind of pools different angel investors at each university and gives founders an opportunity to raise from them. So there are, I would say, two ways to pitch angel investors. One is through angel groups, so these different networks of angel investors like New York Angels. And the way that those are structured is they have regular, maybe monthly, maybe quarterly calls, pitch calls, where you would have an opportunity to pitch your company, similar to Shark Tank, if anybody's watching that show, and get immediate feedback and get connected to a number of different angels. And of course, different online websites like Angel List is another way to connect with a lot of different angels. And then again, your personal network and just understanding if any of the folks within your network or the networks of your immediate friends and family are angel investors, and reaching out to them and pitching your idea. Of course, we have venture capital. So venture capital funds are professional organizations that invest in high growth potential startups. So typically they invest larger amounts, and in exchange they get equity, meaning they get a percentage of your business. So oftentimes they tend to be quite involved. They oftentimes will join a board of the startup that they're investing into, and they provide feedback. And hopefully they also add value. They should be providing valuable introductions to other investors, to potential customers, to vendors that could all be supportive in growing your business. There's also lots of other sources of capital as well. So corporate venture capital is an interesting category. These are, again, professional investment arms of large corporations that fund startups in their industry or adjacent fields. There are pros and cons of working with corporate venture capital. Sometimes they are, this is an opportunity for you to develop a relationship with the corporation itself for potential pilots or potential JVs. The downside of working with a corporate is that it might preclude you from doing business with a competitor of theirs in the future, meaning if you're doing business with Pepsi, you might not be able to do business with Coke in the future. Accelerators and incubators is another great source of funding, as well as great advisory and support. These are programs that are providing a small amount of initial funding along with mentorship and various resources. Oftentimes they take small equity stakes in the business in exchange for their services. There are some no equity accelerators as well. And there are a lot of industry-specific accelerators. So if you're in a specific space, you can do a simple Google search to see if there's a dedicated accelerator for your particular space or geography or industry that you're working in. Government grants and various programs is a fantastic source of capital to start your business. So this is funding that's provided by government agencies to support innovation and economic development. It's oftentimes very industry specific, or maybe they might be targeting a certain types of founders. Again, there are a lot of online resources that are available that allow you to search for whether grants are available in your specific domain. And of course, what's great about government grants is it's non-dilutive source of funding, meaning you don't have to give up a percent equity stake or percentage of your company in exchange for receiving this financing type. And I will add that a lot of times, if you're looking to raise from venture capital down the road, VCs love seeing government grants as part of your fundraising strategy for this reason that it's non-dilutive. There are many other sources of funding as well. So crowdfunding is another category. This is basically raising small amounts of capital from a large number of people, usually online, via online platforms. And this can be in exchange for equity, so equity-based. It could also be donation-based or reward-based, meaning you would give your product in exchange for the investment that people are making. What's important here is that you should already have a large following or a large circle of people to crowdfund from. Otherwise, it might be very difficult to run a crowdfunding campaign because there's certainly upfront cost in setting up a crowdfunding campaign. So it's important to already have either a large social media following or a large group of potential users that could be, could be relevant and folks that you could be asking for funding. And there are different crowdfunding platforms, everything from Republic to iFunds to Indiegogo to Kickstarter. And there are, again, you could search for, if you think this might be the right strategy for you, you could search for, again, doing a Google search, your industry plus crowdfunding to see if there's a dedicated platform, as there are, for example, like AgFunder. AgFunder is a crowdfunding platform specifically for ag-related startups. So there might be something, a platform that's been built specifically for your space, the space that you're in. I would say that with crowdfunding platform, what works really well is CPG companies. So if you have a physical product, especially if it's a consumer focused physical product that general people can relate to, that works really well. If you are working more of a kind of an R&D type of a project, maybe something in material science, that's much less accessible, much less kind of relevant to everyday people that would be on the crowdfunding platforms. So maybe crowdfunding might not be the best strategy there. And of course, there are bank loans, so traditional debt financing from banks. Oftentimes that's very difficult to get for early stage startups because if you don't have any revenue or you don't have any collateral or assets to lend against, sometimes founders will take on debt financing from banks and use kind of a personal guarantee. But again, that depends on a person's specific personal situation. And last but not least, I mentioned revenue-based financing. There are other, there's like receivables-based financing, there's marketing financing, there are other alternative sources of financing that are structured in different ways. So for instance, revenue-based financing basically means that the investors are receiving a percentage of ongoing revenues in return for their initial upfront investments. So lots of different ways to fund your business. I think that the purpose of this conversation is to focus more on venture capital. But that is to say that venture capital is not for everyone. In terms of venture capital, you really do need to be kind of a high growth potential startup. A lot of venture capital funds are looking for the types of startups that can become $100 million a year businesses in terms of revenue. So they're looking for this high potential, large TAMs, so target addressable markets. So if you're not within that category, there are a lot of these other sources of funding, like government grants, like crowdfunding, that could be maybe a better fit for you. So I'm going to just take a quick pause here. Any questions in regards to the different types of funding before we move on to just talk about venture capital? And you can either go off mute and ask a question, or you can drop something into the chat. I'm reading the chat and can respond that way as well. Okay, maybe this was all self-explanatory, which is great. So we're going to now dive into venture capital fundraising specifically. So just within the climate tech space, there are a lot of dedicated climate tech funds. There are a lot of also generalist funds that have a climate thesis. Climate has become, a very relevant, very, very trendy topic. So there are a lot of investors that are looking for super interesting climate tech solutions to invest into. So this market map is coming from CTVC. That's a really great resource. They do a lot of great research on the climate tech space. So I highly recommend jotting down CTVC and spending more time looking at this specific climate tech VC market map. And now we're going to talk about the process. How do I get started? If I have an idea, I want to start a startup. I've never fundraised before. How do I get started? So I kind of was able to break it down into actionable steps that someone can take in order to get started. So number one is obviously creating a compelling pitch deck. If you have an idea, you need to be able to communicate about it. You need to be able to communicate high level what you're looking to build, the vision, the benefits of the product or service that you're looking to offer, and also the benefits to an investor. Why should they be investing into your startup? So compelling pitch deck is absolutely the immediate starting point, and we'll double click on that because that's one of the top 3 tools that I'm going to focus on in this presentation. Once you have a kind of compelling story, compelling pitch deck, and kind of a compelling vision of the future that you're trying to create using your product, then you need to start working on a business plan. So really looking at all of the different elements that go into the business plan, including your go-to-market strategy, your product offerings, your target audience, your target user, and so on and so forth. And then you need to build out financial projections. Obviously, that's very, very difficult to do if your product does not yet exist and if you don't have yet a sense for pricing and so on and so forth. So you have to start somewhere. You have to do a lot of competitive landscape research to understand what how much competitors charge for similar products, how much are clients willing to pay for the value that you're looking to bring to them, and to be able to estimate, say how many users you need to have in order to get to $1 million in revenue, and so on and so forth. Getting a sense of what the financial aspect of the business could look like. And within the financial projections, I recommend doing a 5-year forecast. So looking at what your sales would look like for the next 5 years. What else could be said here? Obviously, investors understand that projections are just that. They're projections, that you're using estimations to arrive at the figures. It's very rare that I see founders hit their projected revenue targets to the dollar. It's definitely, there's room for error. That said, investors will double click on the assumptions that you're using to create those projections. So they need to make sense. They need to be in line with what would be realistic in your sector. Oh, we have some questions. Okay, so there's Eric is asking about examples of terms and conditions startups can expect with VCs. We'll get to that shortly, actually. And how do venture capitalists and investors negotiate investments in exchange for ownership stake in our company? Are there some commonly seen agreements like equity options that come to realization in future, or is it actually a clean upfront trade, such as X% of a company for X amount of dollars? Okay, so we have some questions around term sheet negotiation. We'll get to that in a second. Thank you, Michael and Eric. We'll get to that in a second. So once you've had a pitch deck and you've built out your business plan and financial projections, you then need to research and target appropriate VCs. So there are different databases that exist that kind of lay out all of the investors, the entire universe of investors. And then it's your job to figure out who might be the right fit for you. So you begin to, out of the entire universe of investors, you will do a lot of research to narrow down to see, okay, which ones are interested in sustainable batteries, of those of the investors that invest in sustainable batteries, which ones invest at pre-seed, which is where I'm at, which ones support diverse founders, if that's the case for my company, which ones support startups in the New York State region, and so on and so forth, and continuing to narrow down to arrive at investors that would be very much on target, that would be a really great fit for your startup specifically. After you've done a lot of that work and a lot of that research, and I should mention that it's not enough to get down to like a list of 50 VCs that invest in sustainable batteries, you really have to go in and do the research to see which of the partners at those funds are specifically interested in the area that you're in, and would be a champion for the startup that you have. And that requires a lot of research. Obviously, Twitter, or X as it's called now, is a great resource to see what some of those investors, like partners at VC funds, are passionate about. What are they talking about? What kind of news are they highlighting? Are those news on trend, and in line with what you're building? And if so, this is a high on target investor for you. It's somebody that you want to be speaking with, for sure. So from there, once you've been able to generate a list, and I do recommend for that list to be at least 100, 150, 200 names long. Sometimes where I see founders fail in fundraising is they decide that they're fundraising, they go to their network and they say, hey, I'm fundraising, introduce me to investors. And they might get some investor introductions. Maybe they'll get 5, maybe they'll get 10, maybe they'll get 15. But ultimately, fundraising process is very similar to business development process, where you really need to build out a funnel. You need to build out top of funnel, high-level leads, and then you need to qualify them, and you need to start working those leads in order to get to people that are actually interested. Excuse me. So oftentimes, out of a list of 100, perhaps you might be able to have 15 or 20 conversations, first conversations. Of those, maybe that will lead to 10 kind of more in-depth conversations where investors are doing actual diligence on you, and maybe out of those, you'll get 2 to 3 investors that actually commit. So in terms of fundraising, one piece of advice is for sure having a very, very thick skin, because you're going to hear no much more often than you hear yes. And again, in order to be successful, you really need to cast a much wider net and be able to populate the top of the funnel with as many investors and different investor types as possible, to be able to get to those handful of investors that will actually be able to participate in the round. Thank you, Emily. Emily is getting a clapping emoji. Thank you. So after you've done all of that research, obviously it all needs to be documented. You should be building out your own CRM and keeping track of all of this information. Thick skin. Then you need to begin networking, because the best way to get the opportunity to speak to an investor is to get a warm introduction. The way you get a warm introduction is through your network. So anyone that is connected to your company, whether it's an advisor, it's a mentor in one of the incubator programs, it's okay. Thank you, Thomas. Thank you for stopping me. So CRM is customer relationship management platform. There are some dedicated platforms that allow you to keep track of all of your contacts. So people that you know, with details in terms of like, I met Thomas Yale in 2023, in March of 2023. We've had 3 phone calls. I sent him 6 emails. Last email, he did not follow up. So the CRM platform would remind me and say, hey, you haven't heard back from Thomas. You should follow up. So a way to track relationships and conversations with people. The simplest way to do it, of course, if you don't have the resources for a CRM platform, is to just use Excel. So you can track different funds, contacts, whether or not you've reached out to them, have you sent them a deck, have you scheduled a call with them, and kind of map out the entire journey of the fundraising process and be able to see at a glance where you are at with each individual potential investor that you're speaking with. I hope that answers your question, Thomas. Martin, this is really great advice, especially for those of us who have been getting no's lately. Thank you. Yes, it's absolutely normal to get no's. I think that all conversations are very important. Another piece of advice for that, if you're getting a lot of no's, you should reframe it in your mind as a no for now. Sometimes investors say no because they don't have enough information to be able to make an informed decision on your startup. So you should be following up regularly. So you should have a investor newsletter. And every time you secure a new customer, or you get into a new incubator, or you get some government grants, or anything else kind of newsworthy that shows investors that you're making great progress, that you're on track, that's giving them the data points that they can connect and see that you're on this upwards trajectory, that all needs to be communicated. And it could be possible that at some point in time, even though it might be a no for now, maybe in 6 months from today, when you've gotten more traction, or you've been able to do some successful pilots, or you've been able to secure your first customer, that could all of a sudden become interesting to an investor. The other reason why it's important to speak to investors, whether it's a yes or a no, is that investors are great networkers. They know a lot of people. So if you are upfront and you tell them that these are the types of customers we're working with, it is very likely that they have those types of people in their networks, and they might be able to make some introductions for you. So definitely don't think about it as time wasted or anything of that nature. These are great relationships for you, and look at it as a no for now, and continue to keep them abreast of your progress. And maybe at some point in time, it will become a yes, or they might introduce you to another investor in their network. I tend to do that a lot. If it's a no for myself, I'm always checking to see if it might be on thesis or a better fit for another fund that I'm connected to, that I'm constantly speaking to. Great questions. Thank you for everyone's comments. So network and introductions. Networking is very important. So going to events, going to virtual summits. So SOSV is having a big climate tech conference in October, and it's all online, so you can be anywhere in the world. And they also have kind of an investor matching platform as well. So that's a great way to connect to all of the investors that are part of their network, for example, and there are many, many other opportunities like that. Presenting your pitch, obviously, and finding pitch event opportunities like the angel groups that we talked about. Building out the data rooms. This is basically making sure that you have some support data that supports your vision, that validates your vision. We as investors, we hear a lot of compelling stories, but we need to also ground those stories in facts and in reality. So to the extent that you're able to have support materials and have documents that really validate your thesis, that should be included in your data room alongside a few other things. Engaging in due diligence. So after you've had a pitch with an investor and they're interested, they're going to enter a due diligence process where they will request additional information. Additional information will be put into the data room, or you could share it individually. But it's kind of an ongoing conversation where investors will want to double click on areas that they're most interested in understanding relative to your product or service, whether it's the team or the IP or your financial projections and the assumptions that you're using for that. Those are different areas that you'll need to go into more depth into. And then once you pass due diligence and you have satisfactorily answered all of the questions that the investors have, and they feel very strongly that you're onto something and that your product has very strong potential, then they'll give you a term sheet. And that goes to the questions that were asked earlier in terms of how do we know what terms are going to come? How does an investor determine which terms to provide to a startup within a term sheet? The way that's done is on a comparative basis. So an investor usually would have a very strong sense of where the valuations are for the stage of the company, for the type of the company, for the size of the company, and based off of similar companies. So they're pretty, I would say, it's pretty delineated for what you would expect to be valuations within a pre-seed company in a specific space versus a seed versus another space, but it's all very, very tailored. Yeah, and that's kind of how investors arrive at valuations. I will say that a valuation is it's kind of not set in stone. It's an estimation. And you do, as a startup, have the ability to negotiate on those terms. So whatever term sheet that you receive, first of all, it's non-binding. So it doesn't bind you or the investor. The terms that you receive are subject to you passing the diligence with flying colors. And can be negotiated either up or down, usually down. But yeah, it's something that gets kind of negotiated in the process. And you basically, as a startup, you're kind of at a bit of an information disadvantage because investors see a lot of similarly placed companies. So they have a sense for where the market is, where the market rates are. For the companies at your stage and within your industry. But you would need to do kind of that research and maybe work with your advisors to understand what would be a reasonable valuation for your stage. I'm realizing we're at 15 minutes and we have quite a bit of content to go through. So let's dig in. There are three main, so out of this process, there's a lot involved here, but I would say three very important tools that we're going to double click on. So number one is your pitch deck. Number two is the building out of the target investor pipeline. So this is the CRM that we chatted about just earlier. And number three is the forwardable email. So within the pitch deck, there are different elements that need to be present. Obviously, you want to have a cover slide with your company logo and the tagline. You need to be very clear about what the problem statement is. So what issue or pain point are you trying to solve for your clients? What is the solution that you're proposing? So this is either a product or service to address the problem. What is the market opportunity? So how are your clients solving this right now? What's the size of the potential market for your product? So details about your offering, what specifically are you offering? You could also have a graph here that shows how your offering compares to an existing solution or other competitors in the market. You want to go through the business model, so answering the question of how you make money. It's amazing the number of decks that I see that are missing this piece, but as an investor, we really need to understand how you're going to actually make money. The go-to-market strategy is very important. So this is the process of how you acquire and retain customers. And seeing if there are any, ways to make it smoother. Are there any opportunities for distribution partnerships, distribution channels that could make your ability to get your product into the hands of customers much easier? Having a competitive landscape, so discussing and being very upfront about what the competitive landscape looks like and how your solution compares. Traction, so having current progress, any key metrics, any milestones achieved, as mentioned before. So if you've received any government grants or any clients, any funding, any new key hires that can get you to the next level. Team, discussing what the team's background is, especially highlighting anything relevant that the founders have done in the past that qualifies them as being the team to bring this solution to market. Financial projections, so really including and being upfront about what your revenue forecasts are and when you think you will hit profitability. Funding, how much funding you've raised so far, and also how you plan, so use of funds. How do you plan to use the funds that you're going to receive? What are the next milestones that you're going to get to using the funding that you're asking for in this fundraise? That's very important. So vision, kind of long-term goals, potential exit strategies. So exits are very important for investors because that's how they're able to realize any gains on their investment. So having a clear understanding about how you would exit your potential startup. Call to action, so what is your ask? You can also include any customer testimonials or case studies, any market research that you've done, anything that supports that there are people out there, customers out there who are dying to have your product. Any partnerships or key relationships that you have so far, any intellectual property, technology overviews, high-level strategy of how you're going to protect your idea from, say, a larger competitor coming in and trying to do a similar thing. And then risk assessment and mitigation strategies, that's important as well. Okay, any questions about the elements of the pitch deck? I will say, I'll add just, there's a resources page at the end of this presentation, and I can share those resources in an email format as well, if that's interesting. But basically, I recommend the Sequoia Capital pitch deck template. There's also the Kawasaki template. Those are the two main templates that I would recommend looking at in terms of how to structure your deck and how to present all of the information that we discussed here in a coherent way that creates this compelling story for investors. Yeah, any questions? Feel free to, any questions about pitch decks, please drop it into the chat. But I cannot emphasize enough how important the story is. You know, very high level, you're really trying to communicate why this idea is very important, why now, why is now the right time for this idea, and why you are the team that's the absolutely best team to execute on this idea. If you can cover those 3 points, using storytelling, that's going to really create that interest that you're looking to generate with the pitch deck. Okay, I see no questions oh, I see one question in the chat. I've heard differences on how long a pitch should be. Recently, I did a 6-minute pitch, going to be doing a 4-minute pitch shortly in virtual format. Any rule of thumb here? Great question, Martin. So I would say usually when you're pitching VCs, it's a 20 to 30-minute call. And I would, if it's a 30-minute call, I would say having a 15 to 20-minute pitch prepared and then having time for Q&A at the end. There are these pitch formats like angel groups where there's a very specific time-limited amount that you have. And you just need to be able to have versions of the same pitch, be able to condense it down to either a 6 or a 4-minute pitch. That's very important. And there's even this thing called the elevator pitch. So at some point in time, once you have the entire story mapped out, you really need to understand what are the key points, what are the most salient points, and be able to have it be an elevator pitch, which is just 30 seconds. That's also very important, kind of the tagline of your business, whether you're, we are the Uber for dry cleaning. If you can be able to condense what it is that the value prop of your business into one sentence, that's even better. So having these elements prepared, so that the elevator pitch, kind of the 3 to 5 minute pitch, and then the 15 to 20-minute pitch, very, very important. And then Michael has a question. In terms of pitch deck, exit strategies section, do investors like to see your thinking of exit strategies like possible acquisitions? I have not previously included that section into pitch decks. So if you're a super pre-seed stage startup, you're very, very early stage, maybe you don't have to include it. People understand that you're very early. I would say seed and up is when you definitely need to start thinking about it. Acquisitions is one way of having an exit. IPO is another way of having an exit. So thinking about whether you can build and sustain a large enough business to go public. And in terms of acquisitions, like who's the right acquirer for you? Who would be kind of the company that would make the best fit for your product? I hope that answers the question. Moving on to target investor pipeline. So as I mentioned, we're building out a funnel. So we're starting with identifying the ideal investor type, looking at different databases like Crunchbase, like PitchBook, like Signal, like AngelList, looking at the entire database or the entire universe of investors, and then seeing of those who are going to be the ones that will really resonate with my idea, and doing a lot of research on that. So another way to do research, for example, is if there's a competitor in your space, you could see, okay, you can go on Crunchbase and see, okay, how have they financed their business? Who has invested in them in the past? And then looking for similar investors. Obviously, the investor that have invested in your competitor would not be able to invest in you due to conflict of interest, but looking at similar investors to those investors. Going to startup events, pitch competitions, industry conferences is a way to connect to investors. Looking at the portfolio companies of VC firms to see who invests in similar spaces or similar companies. You can categorize and prioritize this big list. You can leverage your network to get introductions. We talked about that. LinkedIn is a really great resource for that, to see who's connected to investors out of your network, working with your advisors, mentors, any sort of service providers. So if you have lawyers or accountants or anyone else that is supporting you right now, you could be asking them for introductions. So tracking system, so a CRM or just a simple spreadsheet to be able to track all of the conversations and interactions with investors. It's very important. The more you annotate everything and create detailed notes and tasks, the better. It's very, very important to follow up. If you reach out to an investor and they ask you for some information and then you don't follow up, you're kind of burning bridges, because these are all kind of like trust-based relationships. So if you say you're going to do something, you really need to do it. Developing outreach strategies, so crafting compelling emails, personalizing each email to the investor, including your pitch deck, having a mix of warm introductions and cold outreaches, following up systematically. So I was giving this advice earlier on the call that it's very, very important to send investor updates. So that's the best way to follow up with an investor, is to give them some sort of an update to demonstrate that you're growing, that you are on track, that you're meeting new milestones, and then continuously expanding your pipeline. So regularly meeting new investors, regularly asking for introductions and new opportunities. And then it's also important to seek feedback. So I think it was Michael that was getting a lot of no's. You are absolutely in your right to go in and then ask, why is it a no? What could you do differently? What needs to shift in order for it to be a yes? That's all very important for you to then iterate and shift your pitch, shift maybe even your business strategy. If you keep getting some sort of advice that maybe your distribution channels are not right, then you need to think that through. You need to see if there's another way to solve for that in order to overcome that objection. Any questions on the investor pipeline? I'm realizing we're coming up time, but there's a forwardable email slide. That's the last slide. The forwardable email is the best way to generate an introduction from an investor, from an advisor. You're just basically making it super simple to introduce you. You're putting all of the information and being very specific about who you're asking the introduction to. Kind of the biggest mistake I see founders make is they come to me and they say, hey, I'm raising for a Web3 company. Do you know any investors? And the reality is I have 10,000 investor connections on my LinkedIn. I'm sure there's somebody in there that is a fit, but now I have to do that work to try to understand the company, understand who might be the right fit. And it's 30 minutes of minimum of work for me. I just don't have that time. So what would have a better outcome is if somebody comes to me and says, hey, I see that you know John Smith at a Web3 fund. Do you know him well enough to introduce us? Our company does X, Y, and Z, which is very much in line with what John Smith looks for. And then it's a very easy yes or no for me. I'm just saying, yes, I know him really well, be happy to forward the email. Or I say, no, I don't know him well enough. Check the rest of your network if somebody else might be a better fit. That's it. There are some resources. There's a specific thing on forwardable emails in here. There's an entire investor database, a way to build out a target investor pipeline, some pitch deck templates, and a kind of a generic resource from YC. So that's Y Combinator, one of the best accelerator programs out there. I can share those in an email, given that we are now out of time. So I'll pass it back to Shannon.
Thank you so much. Yes, down to the wire, but that was, oh my goodness, such an amazing plethora of information. And I'm so appreciative that you really kind of got down to the core of how to start fundraising, all of the really, really important details that we need to begin at and to really understand kind of the nuts and bolts of starting that process. But thank you so much, Olga. If you're comfortable with us sharing the deck, we can connect, and I can share that with the folks so they can access the resources and any of this information afterwards. We did record everything, so we'll shoot that to everybody afterwards as well. But again, thank you to Olga. Thank you for everyone who attended. We have our next webinar next month. Be on the lookout for that information. That's going to be on personal finance with our friends over at Visions Federal Credit Union. But thank you all so much, and we'll see you next time. But again, Olga, thank you so much. We had a question about connecting with Olga afterwards.
Feel free to connect with me on LinkedIn. LinkedIn is probably the best way to connect to me and investors more broadly. So
great. Thank you so much.
thank you.